Hi guys, Kevin Al from Infinite Wealth here. Today we're going to go over 20 rules every investor must know. We're from the Omaha metro area here, so we kind of put these together. These are kind of Warren Buffett's rules for investing. Let's get started right away. Number 1, don't take more risks than you have the ability, willingness, or need to take. Many investment plans fail because investors take on too much risk. Many people look at the equity returns and they think they can handle a 100% all stock portfolio to get the higher returns without knowing their downside potential is losing more than 50% of their money. I knew people that were millionaires before the 2000 crash that lost 90% of their money because they owned only tech stocks. A 60-40 stock bond portfolio would have lost 30% and they would have still been wealthy. Today, think about a 100% Bitcoin portfolio and the risk you would be taking. Number 2, never invest in any security unless you fully understand the investment and all of the risks. If you cannot explain how the investment operates to a friend or family member, you shouldn't invest your money. Again, never invest in anything that you do not fully understand. Number 3, hope is not an investment plan. You will be best served to base your investment model on peer-reviewed financial journals, Nobel Prize winning economists, and Austrian economic theory. I will help you to do that. Number 4, never buy an investment that is intended to be sold. The more complex investment products that are designed to be sold to you by an advisor will almost always carry high fees to benefit the advisor. You are not special. Your financial planner doesn't pitch special products only to you that will result in higher returns because they like you. Number 5, never work with a commissions-based financial planner. No explanation needed. We went over that in number 4. Number 6, risk and expected return are related. Without risk, you do not have the opportunity to potentially make a higher return. Returns are not an absolute in the short term. Buffett says in the short run, the market is a voting machine. In the long run, it's a weighing machine. Number 7, a well-designed plan is essential to succeed in investing. Without a written investment policy statement and the discipline to follow it in good and bad markets, your chances of success are drastically reduced. You will invest based on your emotions, which usually ends up with you selling low and buying high. Number 8, if you diversify, you need to accept tracking error. 2017 was a great example for the S&P returning 18.74%. A portfolio with any bond exposure certainly would have returned less than that 100% stock portfolio. You accept that lower return to avoid the minus 37% return of 2008 when a portfolio with bond exposure would have outperformed the S&P 500. Number 9, investment plans must be integrated with tax strategy plans. Investing in a tax-efficient manner is essential to your long-term returns. If you are invested in a tax-inefficient manner, even with the higher returns it may bring, the only returns that you can truly count are the after-tax amounts in your account. Number 10, getting wealthy is a totally different game than staying wealthy. You get wealthy by inheriting assets, which is actually not very common, or by taking calculated risks. You maintain wealth by minimizing risks, diversifying your investments, and not spending too much. Number 11, if the security has a high yield, you can be sure the risks are high even if you can't see them. Think corporate bonds in this low interest rate environment. Many investors are chasing that yield without considering the risk. I don't invest in corporate bonds because they have equity type risks with bond type returns. Number 12, there is only one thing worse than having to pay taxes, that is not having to pay them. Many people in the 2000 bubble lost millions of dollars because their cost basis was low and didn't want to pay taxes on their capital gains. In the end, many of the gains were converted to losses because they refused to lock them in and diversify. Number 13, your portfolio is the safest if it is diversified. You must include appropriate allocations to at least the asset classes of large cap and small cap, value and growth, international developed markets, emergency markets, real estate, and bonds. Number 14, the price of all stock and risky bond assets tend to fall during financial crises. Your plan needs to have rebalancing procedures and a plan to buy stocks during severe market downturns. Some of the best returning money I have ever invested was during the 2008-2009 period. Have a bucket to catch the gold, not a thimble, is what Buffett says. Number 15, stock picking when you factor in taxes and expenses is a loser's game. If you are a risk-averse investor, you are best served by using only low-cost, tax-efficient, and tax-managed investments. Number 16, owning single stocks and sector funds is more speculating than investing. The markets compensate for risks that cannot be diversified away, like stocks versus bonds. Owning a single stock is a diversifiable risk, and you shouldn't be expected to be compensated for it. Number 17, take your risks with stocks. You need to have an appropriate amount of bonds in a portfolio to reduce the risk to a level acceptable to you. You should not take additional risk on the bond side of the portfolio. If returns aren't high enough to meet your needs, you need to tilt towards small and value instead of taking risk on the bond side. Number 18, the market can remain irrational longer than you can remain solvent. Bubbles like 2000, 2002, and 2008 do occur from time to time. Buffett says every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. When downpours of that sort occur, it is imperative that we rush outdoors carrying wash tubs, not teaspoons, and that we will do. Number 19, there is nothing new in investing, just the things that have happened that you don't know. History doesn't necessarily repeat itself, but it usually rhymes. Knowing financial history will help you to anticipate risks and factor them into your financial plans. Number 20. Good advice doesn't need to be expensive, but bad advice will cost you dearly, no matter how little you paid for it. I don't choose the cheapest mechanic to work on my BMW. In the same way, you shouldn't try to go with the cheapest fee-based advisor and CPA for your financial plans. Costs matter, but you need to have an idea of the value added to you versus the cost of the advice. And then finally, a bonus. The 5 most dangerous words uttered in the investment industry are, "This time it is different." Thank you for watching.
Tell me pretty lies, look me in the face, tell me that you love me, even if it's fake.